This is the Definitely Uncertain podcast, brought to you by Gold Rock Capital. Each week, we look at how high net worth families can improve their lives, decisions, and investments in a deeply uncertain world. We always aim to provide practical information, even if we can't offer specific investment advice.
Welcome to the Definitely Uncertain podcast by Gold Rock Capital. My name is David Ram, and I'm a partner at Gold Rock Capital, the 20-year-old multifamily office servicing high net worth investors across the globe. With me today is Anthony Scaramucci, affectionately known as the Mooch, founder and managing partner of Skybridge Capital, the global hedge fund of funds. Welcome, Anthony.
Good to be here, David. Thanks for having me. I wish I was with you wherever you are right now. You're in Tel Aviv. Where are you?
I am sitting in between Tel Aviv and Jerusalem in a little office park. Yeah.
One of the more beautiful places in the world. Well, God bless you. I hope your family's safe and healthy.
You too. It's a crazy time we're living in today, so I hope you guys all stay healthy and safe. There's a few topics that I want to get with you today for a few minutes, but perhaps to begin, for our audience, which is primarily Israeli, and may not know of you as much as the Americans know you, perhaps you could just give us a quick introduction.
Okay, wow. Well, I'll get it down to 30 seconds. I grew up in a blue-collar family out on Long Island. My dad was actually a crane operator at a local sand mine, which is now a public golf course. He spent 42 years there. I went to Tufts and Harvard Law School, which is sort of an interesting part of my life story because nobody from that area did that. And then I went on to Goldman Sachs. I spent 7 years there. I had written in a notebook at age 25, if I could get my school debt paid off, I would go start my own business. And pursuant to that dream, on December 1st, 1996, I started my first company. It was sold to Neuberger Berman in 2001. And then Neuberger was bought by Lehman. And then in 2005, I left Lehman to start Skybridge. And so I've spent 15 plus years now at Skybridge, minus 11 days where I was in the White House as President Trump's communications director, which was a sordid tale, but also a lot of fun. And I'm glad it happened to me in my life. It was a good life experience about the trials and tribulations of politics. I've got 5 children, and I live out here in suburban Long Island, about 20 miles from the city. And my office is on Madison Avenue.
Lovely. That's a great intro. Those 11 days are somewhat infamous in American history now. What I want to start though, to start with, at least on the investment side, and then we can move maybe and bridge that into policy and politics a little bit. So first on the investment side, I actually participated yesterday in your quarterly call at Skybridge Capital, and the CIO there mentioned 2 data points, which I thought was quite interesting. One relates to the bond market, the other, the equity market. He said essentially that the bond market today, there's no income, no hedge value. The equity market is essentially trading in the US now at 23 times 2021 earnings. Very difficult environment in the liquid markets. How are you guys at Skybridge today navigating that difficult environment?
Well, I mean, I think his point, and again, look, I mean, I want to also be very upfront with everybody. We got shellacked in March. We had our worst month in our 15-year history, primarily because we were loaded up with structured credit. We like structured credit long term. We actually liked structured credit in March. The great irony is that it was actually the result of the interest rates going down. The assets that we held, assuming that the cash flow analysis was correct, the assets were actually more valuable, but there was a panic in the market and some leverage and technical overselling. And so I think the point our CIO was trying to make is that we've got probably a 20 to 25% return upside profile with very limited volatility because our assets are so cheap right now. And remember, as you know, we're a fund of funds. And so the hedge fund managers that we're invested in, which are arguably among the best at what they do, there's high watermarks. And so our clients right now are going to get 100% of the profits on the way back up, which is why we've raised a lot of money from institutions around the world who see us as a great feeder fund. If they went in directly to that hedge fund with new money, they're paying 1.5 and 20, but they come through us into that hedge fund, they're paying like 75 and 3 or something like that. It's a very interesting time for us. And so the great irony is, despite our performance weakness, good fundamental investors are putting capital with us. And I think what our CIO is really trying to say is that there's very few pockets of double-digit mid-teens returns. We think it's going to be more than that. I can explain why in a second, but mid-teens returns without taking exogenous risk or excess volatility. You certainly can't find that in the vanilla bond market. In the stock market, obviously, you've got a tale of two cities. You've got the tech stocks and some of the higher multiple growth stocks zooming, and you've got rotation that is always threatening to happen, but never stays with any level of duration away from those tech stocks. So it's a very bifurcated market. And I think our guy feels that that's dangerous. And so we like what we own. What I said to somebody when we got crushed in March, I said, okay, imagine we owned a building together and we knew every single rent holder in the building. But now we're in a COVID-19 environment. That building, unfortunately, because of the stress in the system, if we had to sell it today, we're going to have to sell it for a 20% discount. But that cash flow is remitting from the building every single day. These are white collar people that are, in high paying jobs. They can work remotely. Well, guess what? That building is worth holding on to. Let's not sell that building. Let's not panic out of the building because we have a number in front of us that says it's worth minus 20%. Right. And I think you gotta think like that as an investor. What's made my career, and literally started minus $150,000 net worth when I graduated from Harvard Law School. What made my career is duration, persistence, riding curves. I got destroyed in 2008. And when I came out of 2008, and that'll still be our worst year. I mean, we're likely to close down 10 this year, which is a shitty year. I'm not saying it's good, but in 2008, we were down 20%. People were leaving the fund. I told them, please don't leave the fund. The stuff's very cheap. We had a 60% move over the next 4 years with very little volatility as a result of that technical overselling that took place in 2008. So I'm very optimistic for 2021 and 2022 for Skybridge. And I think that was the point that Ray and Troy were making on our CIO quarterly call.
Yeah. And you mentioned you had a rough March. Many funds had a rough March, obviously, especially.
Are you recording this, Ram? I just want to know, are you recording this? Because I'm moving in with the Rudolph cup. If we're recording.
But you gotta move it slow so the recording can capture the Rudolph. There you go.
Yes, I'm moving in with the Rudolph cup. I want to take some coffee as you're talking. Go ahead. Say Merry Christmas. Happy Hanukkah to everybody in Israel. There
you go.
But everybody loves Rudolph. You can be a Jew or an Italian. You can like Rudolph, right? Everybody loves Rudolph. Go ahead, Ram. I'm sorry.
That's true. It's going to be a rough Christmas in democratic states. I'll tell you that. Be very lonely. In terms of the portfolio construction today. So yeah, you guys have been long structured credit. I've always enjoyed going to your SALT events in Vegas, primarily because I was able to meet interesting structured credit managers, which were hard to access in cap intro events, which are heavily equity focused managers in those events. So you've been long structured credit for a long time, and now it seems like you're rotating a little bit out of that. You're obviously still a majority structured credit still, but it seems like you're migrating a little bit towards these very large, well-known managers. I saw a list recently of things like Canyon and Third Point and Point 72, et cetera. During that rotation process, what are you concerned about? What are you looking out for? Is there transparency challenges with those managers? Obviously, it's a bit of a different approach to what you've normally done over the past number of years.
Look, I think it's a great question. And one of the things about Skybridge, which I think has allowed us to work so well successfully, 15-year-old firm, Ray and Troy running that fund together for 15 years, is, I'm the managing partner, I'm the majority owner of the firm, but I let those guys run the investment process. Mm-hmm. And I have a lot of faith and confidence in them. And so what I would say to you is that was their decision. Okay. What happened to them, I think they felt that they wanted to stay long the structured credit, but they saw depression in the equity markets. They saw activity in distressed credit that they thought would be, and I'll quote Ray Nolte, he's been through 5 or 6 distressed credit cycles in his 35-year career on Wall Street. he thinks this could be the best one.
Hmm.
And if you look at somebody like Third Point or Canyon, since Ray made those investment decisions April 1st, they're up 29 and 22% respectively. And I think those were really good choices. And so only thing we cut from our structured credit book was what we call these TRUP securities. These are securities that are owned by companies like EJF. They own a very large tranche of this. I'm drawing a blank on the second company that we had a big Hildene, correct. Thank you. Hildene. That's Brad Jefferson's firm. I would have gotten his name right, but I lost the name of his fund. But those two guys, love those guys. They're very, very good long-term investors. But Ray and Troy felt at this moment in a COVID-19 situation where community banks have their balance sheets tied up in commercial suburban office buildings, commercial retail shopping centers or strip centers or malls, that it was going to be harder. It's going to be harder for them to get cash flow payments. They could have some potential defaults. There could be buildings that are half filled, high vacancy rates.
Right.
And so they made a ruthless decision to sell out those two names, buy Third Point and Canyon, and they paired some of our convertible bond exposure and some of our long short exposure and gave it to 0.72. Now, why did they do that? Steve Cohen's a personal friend of mine, and it looked like as a result of the crisis, he was going to have some capacity for a firm like Skybridge. And so, Ray called me. This is one of the beauties of our business, and some of it's born from the SALT conference and other things. Ray called me and said, hey, listen, I'd like to make these changes. We're going to get rid of our Trump security exposure through AGF and Hildene. I'd like to put money with Canyon because we think distressed credit, corporate credit, and I can explain why in a second. And Third Point is well positioned for what we think will be a reflation in the equity that Dan Loeb likes. I said, okay, no problem. We had access to those two. We did not have access to Steve. I picked up the phone and called Steve. We've known each other for 30 years. And he said, no problem. And so we put some exposure with Steve. He's done phenomenally well this year. I think he's up 12 or 13% this year. And so all of that is really Ray and Troy. I think that the big message to people is that Ray and Troy want to run the fund concentrated, but they also have a dynamic element to that portfolio. And when the breach happened, they were pretty ruthless about making some changes. And we've had a 14.5% rise in G, 17% rise in G2. And again, I think we're pacing to have a 25, 30%, 12 months, which I'm very excited about. And, our business, it's not what happened yesterday. It's what's going on in the forward windshield. What's the future going to look like? And I'm very optimistic about that for Skybridge.
Yeah. So it sounds like the positioning today is a little bit on the consumer, on the housing side. You're kind of maintaining the RMBS strategy, the residential mortgage-backed security strategy. You're adding some large managers that have a good reputation and a good track record.
And shedding the community banks. So that was like 20% of the portfolio. We shifted it into those other guys.
Exactly. And you mentioned distress. So distress is an area that we've invested with our clients as well over the past number of years. And we've upped some allocation recently. Particularly, I've noticed in the hedge fund space that a lot of the hedge fund guys raise drawdown vehicles in order to enable new investors to add capital to fresh opportunities as opposed to buying into existing portfolios. So it's a bit of a challenge in the hedge fund space, but Canyon seems to be doing a great job. How is that working out for you in your portfolio?
So again, this is classic relationship management. Josh and I are friends, know each other a very, very long time. I have two of my older sons are living in LA. And so Josh, unfortunately, is their designated godfather. He's the Jewish godfather for two Italian kids.
Sure.
And so when they have a dental problem, they call Josh. If they have a dermatological problem, they call Josh. I mean, he's like a maven for every doctor in the LA County. And so he's got a great relationship with my kids. He had a horrific month of March. He'd probably be mad at me for saying it like that, but I had a horrific month of March. And so I called him. I think he was down 30% in March. And I called him. I said, how you doing? He said, well, I'm not doing so well. He said, but you can't believe what I own. let me send you a PDF of the portfolio. So he sent me a PDF of the portfolio. I sent it over to Ray and Troy with his permission. They looked at it and they said, oh my God, this portfolio is yielding 20%.
Right.
And he's got stuff in this portfolio that is worth probably 25 to 50% more than it's currently trading at on March 27th, let's say. I think that was the day I looked at it. Right. So I called him and I said, listen, I said, I want to come into the portfolio. He had the thing marked on the bid side, which I think was a very smart thing for him to do. Most of these guys mark mid-market, between the bid and the ask. He marked it on the bid side because his attitude was, I'm taking all the pain in the month of March. And so we bought into that portfolio on the bid side on April 1st. And this is something that we're capable of doing. This is the dynamic process. We've got the relationship with him. He likes and trusts us. Right. Wham, I think we sent him $200 million in 13 seconds, having analyzed that portfolio with our credit team. And I think he's up 22. I think Loeb is up 29 from those lows. From April, and I think that's the point to people. Keep a steady hand, okay? Don't be a gun waver. Okay, if I can leave a message on this podcast for people, don't be a gun waver in life. What's a gun waver? We're at the OK Corral and you're ready to draw. Okay, what are you going to do? Are you going to start waving the gun or are you going to be calm and you're going to hit the target? I'm not a gun waver as an investor. And so, I mean, that's a big lesson. Do not be a gun waver. Stay steady and hit the target.
Right.
Or as Michael Jordan says, give me the goddamn ball.
Right.
I'm going to put it right through that hoop right at the moment that I need to.
Exactly. No, it's interesting. That's a good segue to politics. I'm not going to get you into the whole Trump conversation because you and I are going to go at it. But in terms of politics, which is in my opinion more on a policy side, I guess I could say, because you have an interesting story. You come from more blue collar, humble upbringing. You now are the quintessential Wall Street guy, and over the past decade or so, there's been a bit of a dispersion between those two groups in the U.S., which I think is perhaps one of the reasons why Trump emerged in 2016, where you have this wealth gap growing, the disparity of wealth growing between the super wealthy and the middle class, or even the working poor, if you want to call it that, where interest rates are zero or very close to zero. Incentive structures are in place to borrow and buy assets. And then the people who are left behind are the guys who get a $1,000 medical bill and are screwed for a very long time. And that growing disparity is very concerning in the U.S. In terms of policy, what do you see in a positive policy that's out there, that's in the pike, if you will, that could actually address these challenges, which I think Trump was trying to address on the labor side by squeezing labor markets with build the wall, tariff China, improve labor value within the U.S. borders. I think he succeeded a little bit in that front. But what's your perspective moving toward, I guess, a new administration as well, toward policy that could help with that big disparity?
Okay, there's a lot there. So I'm gonna talk concisely.
Yeah, give me one.
I'm assuming you don't want to debate the Trump stuff, so I'm not going to debate the Trump stuff. And I was on the campaign with him, 71 campaign stops, and I saw the people he was talking to. Those are the people I grew up with. And those people, like my dad, were aspirational blue-collar people 35 years ago. But because of globalization, because of robotic technology, a whole host of things, including the Federal Reserve, who has basically monetized U.S. debt and crushed U.S. savings accounts, and a result of which has crushed living wages in our society. The bottom half of the society has really suffered. And so these people have gone from aspirational working class people to desperational working class people in 35 years. That pains me to no end because I grew up in an aspirational working class family. My dad would come to the dinner table 5:15. You'd get hit with a belt if you weren't sitting there at 5:14. And he would tell you to do your homework, and he would tell you that you're going to live the American dream because you're going to eventually go to college and you're going to make something of yourself. Right. Those people are now struggling and they're downward shifting economically. So I want to praise President Trump for seeing that dilemma and recognizing that those people had a vacuum of advocacy in the establishment political class who get removed. And I'm going to also indict myself in this podcast and tell you that I should have seen it because of the way I grew up. But let me tell you what happens to you, David. You get to confirm biases of the people that you hang out with. So if you're hanging out with wealthy people and you're going into the salons of wealth and you're hanging out at Davos, Switzerland, or in a boardroom at a Wall Street firm, you're starting to insulate yourself from what's actually happening in the heartland of America or in the Rust Belt or other parts of America. And I want to praise Mr. Trump, President Trump, for seeing that.
Yeah.
However, he did absolutely nothing to help those people. Nothing. The building the wall didn't help those people because the wall never got built. It's like 10 miles of the wall, just a fake news story. The situation with China, he totally mishandled. He botched the trade situation. I tried to explain to him during the campaign that we needed the TPP, not because I'm a Wall Street person, because I understood that we need to have influence. If you're going to check Chinese power globally, the United States is the largest Pacific power.
Right.
You know, our coast, our Pacific coast, and our reach into the Pacific, we're the largest, most important Pacific power. Okay, yes, China has more people and their economy's rising, but we could have, with the help of TPP, checked China and checked some of the trade violations and impractices and copyright infringements. Moreover, we also tried to explain to Mr. Trump, team up with the Europeans. They have the same trade grievances as we do. That's 1 billion people and money talks in China and bullshit walks. You know that, power and money.
Yeah.
But we didn't do that because Mr. Trump needed to make it 100% about himself. He needed to hijack the party. To quote Jared Kushner, his son-in-law, it was a hostile takeover of the Republican Party, and they needed to hijack the party and subvert the party and not even have a party platform coming out of the presidential convention. So these ideas and these solid principles and these great policies would have helped those people. But Mr. Trump, it wasn't about that. He was really about himself. And so most of the policy decisions, including the policies related to Israel, were born from self-interest and personal expediency. They weren't born from any long-term strategic planning. And what I would like to see happen for the state of Israel, frankly, is that this does not become a political football. The very, very good news for Israel, it is incredibly strong, economically vibrant, culture. It's a great country. It is a standalone country in terms of its ability to protect itself. And God bless that. And God bless the state of Israel. It doesn't necessarily need the United States. But let me tell you something. We've had a 70-plus year phenomenal partnership and alliance. And I don't want that alliance to be partisan. I would like that alliance to be no daylight between anybody in the United States and Israel. And I want it to be a bipartisan commitment. And one of the things that Mr. Trump did was he spoiled that. And so we've got to get that back on track. And so let me get the Rudolph Cup out again now, because, you know, I'm sure you're pissed at me. So I'm putting up the Rudolph Cup so we get a little smile out of you.
Right.
Now let me toast myself now with the Rudolph Cup so you don't get too mad at me. L'chaim with the Rudolph Cup. Don't get too mad at me. Just telling you my opinion. That's why you invited me on.
I was going for Kanye West. Let's be clear. I was not going for the.
Let me tell you something. Those 72 million people? They need a policy solution to help them with their lives. Exactly. Once they get that anger will dissipate.
And so back to that. That was my question. Do you see there's a real policy opportunity facing the new Biden administration? Is there something in the line that they're going to implement that would actually address those frustrated people, and I think rightfully so frustrated, by the way?
Well, listen, we have a divided government in the great wisdom of the American people. And I predict that the Republicans will probably hold the Senate, just given what I know about the state of Georgia.
That's where I'm from.
And, if they hold the Senate, you're going to have a divided government. You're going to have to ask Mitch McConnell to come on the podcast. If he's going to want the Senate to do the number on Joe Biden that they were trying to do on Barack Obama, we're not going to get anything done.
Yeah.
But if they get together and say, you know what, the American people voted for a divided government, let's try to meet in the middle here and create some progress. There's an education bill, there's an infrastructure bill, there's a jobs training bill, all of which those two parties could meet in the middle on. You might be able to get something done, and a result of which that would be really good for America. It'd be really good for the 72. I think it'll actually be 73, 74 million people that voted for Donald Trump. But you know what? There were 80 million people who voted for the other guy.
Probably.
You know that? How good
Absolutely.
is that? Okay.
That's right. So I want to end on a positive note because politics is rough. But one thing I've always found very compelling about your story is, you're in an industry, the hedge fund to funds market, which has taken a real beating, I would say, since 2008. And you guys at Skybridge have really been able to maintain, both in terms of the marketing side and in terms of the client retention side. And you mentioned about relationships, the importance there. A lot of our clients and a lot of prospective clients that listen to this podcast are entrepreneurs. You're an entrepreneur. I'd love to understand how, just a couple of anecdotes about how you have been able to maintain and continue to build on a business in a difficult, very difficult market, which arguably has some secular trends against it.
Well, I mean, it depends on how you look at the market. If you're a fund of funds and you're targeting institutions, I can understand why they're in secular decline, because the institutions want to go to direct and they want to save those fees.
Yeah.
But if you're a smaller family and you don't want to build all of that apparatus, okay, and you have inside of Skybridge, 35 years of experience with Ray, 32 years with me, 22 with Troy, et cetera, and you have risk management, legal, qualitative and quantitative assessment of managers, a 1,500 fund database called Hedge Fan that we created ourselves, proprietary model, you're going to outsource to us. And so if you're a dentist in Davenport, Iowa, that was always my idea. I wanted to be the hedge fund manager for every dentist in America. And you're sitting there drilling teeth and you got $1 million in net worth and you want to have some of that money with Steve Cohen, but he's got a $25 million minimum. You can put $50,000 in our fund and we can give you a little bit of Steve Cohen, a little bit of Dan Loeb, and the rest of these superstar managers. And it's 5% exposure for you on your liquid net worth. And lo and behold, you have 29,000 clients. And it's a very sturdy, very stable business as a result of that.
Yeah.
Look, we lost clients as a result of our March debacle, but we've also gained clients, and that's what makes the market. I would tell your listeners two things, okay? It's never as good as it looks at the top. It's never as bad as it looks at the bottom, but you should live by the adage of Mel Brooks. When I got fired from the White House, July 31st, 2017 was a rough day, man. I was getting rolled in broken glass. Then I was getting salted with Israeli sea salt. And then I was getting lit up by late night comedians. So it was a pretty rough day. I mean, let's just be honest. Okay, that's a pretty rough day. So if you're having a bad day, David, I want you to think of my ass getting fired on July 31st, 2017. But I got up that day with the very same adage that I have every day, and it's from Mel Brooks. Do you want me to share it with you and your listeners?
We're huge Mel Brooks fans, as you can imagine.
The legendary Mel Brooks, who is obviously a comic genius and a genius in so many other ways and a polymath. His best line, in my opinion, ever: relax. None of us are getting out of here alive. Okay. I mean, isn't that a great thing to say? Okay. Just relax. We're not getting out of here alive. Let's enjoy the experience, the ups and downs of it, and see through the darkness, through the other side of the tunnel, and good things will happen to you. But you got to believe. You got to have a lot of faith in yourself, and you got to believe, and you got to also have a sense of humor when shit is going bad.
Right. No, it's great. That's a good ending of the message for the podcast. I really appreciate it. This has been great. It's always good catching up with you, Anthony. And I very much look forward to seeing you back in Tel Aviv. Maybe next time in Dubai. I know you guys do events out there.
I can't wait. We did it. We had the first Israeli venture capitalist in the history of the Emirates speak at our conference.
Oh, wow.
It was the first public speech in December of last year. And so I'm thrilled that happened on Skybridge, and there's nothing that makes me happier than seeing that connectivity. And I want that to grow and prosper. And, like you, I love people. of all walks of life, shapes and sizes, and we can do more together than we can do apart, obviously. So let's see if we can figure this out.
Well, thank you so much. And thanks everybody for listening to this episode of the Definitely Uncertain podcast by Gold Rock Capital. Anthony, take care.